Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hi everyone. So first of all, I just want to start by apologising in advance if my words blur today or if I have to repeat myself. I've had about an hour and a half sleep because my partner has appendicitis and we had to go to emergency last night. So I slept on the corner of the emergency room. So if I'm a bit vague, I apologise. I guess the other lesson for you guys before we go into the actual content is if you have a pain in your right side and you've had it for about half a week, don't just assume you hurt yourself at the gym, because it turns out it might be appendicitis and it can get quite bad if you leave it and just ignore the pain for 5 days. So, yeah, I'm a little sleep deprived, but we should be fine. So what we're going to do today is look at more methods of asset allocation. Remember, and I'll go to the plan that we sketched out last week, but remember in week 3 we looked at our main method of asset allocation, and when I say main I mean it's what you guys have learned up to now, right? Because in prior courses there was a big focus on the theory, which is important to understand, but now in this course we shift the theory to reality. Now the natural starting point when we look at how to take the theory and apply it in practice is mean variance theory, because modern portfolio theory is the start of what we learn in finance. So what we did in week 3 is looked at how we use portfolio optimization to get a set of asset allocation weights. What we looked at in week 4 is that the trouble with mean variance optimization is it's really sensitive to input assumptions, which means that we might end up with an allocation that can be quite extreme, a corner solution. What we're going to look at this week is some alternative methods in addition to mean variance analysis. Now, some of the things we look at this week you could use instead of mean variance analysis, and some of the things we look at you might choose to use alongside of mean variance analysis. In the assignment, I'm going to ask you guys to use more than one method. You might choose to use a particular form of optimization as one method, and a fundamental risk approach like we look at today as another. It's up to you. You might choose to use 2 different forms of optimization, but they might be based in different areas. You might have a yearly bootstrap and a quarterly hypothetical rolling portfolio. So one of the focuses for the assignment will be to take you through how a lot of the methods that we've looked at in the course can be applied to the investors that you're given. Now, by the way, when it comes to the assignment, you should have it. I'm aiming to give it to you by the end of this week, but you'll definitely have it next week otherwise. You're only starting to get to a point where you could start to address the task in the assignment. My guess is by week 6, if you didn't have a mid-semester, you'd probably feel like you're about ready to get started. I know you guys do have my mid-semester exams and other mid-semester exams, so I suspect no one will start the assignment till the mid-semester break. But remember, you need to sign up for assignment groups on Wattle by Friday. And it's really important to sign up for an assignment group. If I go up to the top, right? Make sure you please do sign up for an assignment group, because obviously we're going to mark based on the groups that we see. And for the same reason, please don't go changing groups once the deadline closes, because you've got your groups in Wattle. When we mark an assignment, only one of you is going to submit it. So one of you will submit the assignment. If you're in a group of 6 and the people in that group have changed, we won't actually know that, because we're going to have the assignment group set up in Wattle, if that makes sense. If there is something that happens where the groups have to change, just email me. Don't change without letting me know. Ah, I'm starting already, sorry. What I had meant to do, I didn't realize that it wasn't on the computer screen. Assignment groups, right? This is what you've got to use to sign up for the assignment. I knew I was in trouble when I got my password wrong the first 3 times I tried to log into that computer. All right, so this is what we did together last week in the lecture. Now, by the way, the lecture recording for the first part of last week is really poor. I apologize for that. It's because my lapel mic wasn't working. I had no idea just how important it was. So I will make sure this is always switched on and not muted. The good news is that the recording was really clear by the time it came to the in-depth discussion of the lecture slides. The bad news is, had the recording not worked for the lecture slides, I could have easily taped it again. Unfortunately, what didn't work is us all being here together talking as we sketched this out. So you can hear the words in the recording. It's not very clear for that first part. I apologize. It's the one thing I can't go in my own time and recreate, because it was a discussion, right? I can't sit there and remember what I said and what you said and what I said and what you said. So hopefully it is clear based on what we drew together, and I'm going to go through it again now for the same reason. But if you have any questions about that first part that aren't clear in the recording, please let me know. All right, so remember, we said that this course starts with the view of having a big multi-asset class portfolio. And the main one we look at is a superannuation fund. So you have a lot of money together, ready to invest. It might be to invest for an individual investor, or it might be to invest for a pool of investors. Ultimately, what you need to decide is the weights to put in your different asset classes. But there's a whole process that sits in between. So remember, week 1, we learned sort of the broad process of an asset allocation or a portfolio construction framework. We learned what we were going to cover and the importance of governance. We're going to go back to governance in our final week, but essentially we're going to spend all the weeks in between understanding how to go about forming an asset allocation and implementing that allocation. So remember, in week 2, we said that we can't actually decide on an asset allocation until we understand our investor. Why is that? That's right, for the investor. So in the assignment, and forgive me, I might have said this last week as well, but in the assignment, I'm planning on giving you 2 investors. Those 2 investors will have different objectives and constraints. So I wouldn't expect you to recommend the same portfolio for each investor, because everybody wants something slightly different. We have different objectives. We have different risk appetites. We have different key risks. We have difference in things like our need for liquidity, our personnel risk, peer risk, and all of the other risks that we looked at in week 2. So we need to understand who our investor is and what they want. Once we do that, we can decide on our asset allocation approach. So remember, I said that in week 3, we learned the first big asset allocation technique, which is mean variance optimization. What's the easiest thing about mean variance optimization? Why is it so popular to use? It's automatic, right? You have to properly set up your constraints in Excel and your objectives, but then when you tell Solver to run, it will come up with an asset class, with an asset allocation for you. But what's the downside of that? What's the risk involved in optimization? It could be unrealistic, yeah. Yeah, it could be unrealistic because it's very sensitive to your input assumptions, right? The optimizer will happily tell you to go and short fixed income and put all of that wealth plus your own wealth in commodities or private equity. It doesn't think about things like data smoothing for direct property. So if you use mean variance optimization, it's vital to have an overlay of your own personal judgment, because humans can do what machines can't, and that is understand the intricacies involved that aren't reflected in the data. We know that there is a risk of a piezo problem. Remember from last week, what's the problem? When the optimizer sees an asset class that is subject to the piezo problem, what is the issue? What will the optimizer see and what will be the reality? Yeah, they'll put a lot of weight on the asset class with the piezo problem. Why will it like it so much?
Because it's kind of flat, then the risk index, but in reality, Argentina is the
Yeah, so Argentina is the reason it was first called the piezo problem. In reality, the data looks like the returns are high and strong, but in actuality, there was a massive risk of default. It just may not have occurred in that particular data series. Right, so we know that sometimes when an asset class has really high returns, it's for a good reason. It's because it's really high risk. But remember, we don't observe risk. All we observe is the return that eventuates. Think about what happened today. We woke up this morning knowing there was a risk of a leadership spill. We don't observe that risk. We observed the outcome of the vote, right? So if the event, let's say that a risk to you happened to be a change in leader. The leader didn't change, so the data doesn't reflect it. You can look at the press, you can remember, but if you're just looking at who is the leader in a bit of data, you're not going to see that leadership spill because the outcome wasn't affected, at least at this stage. Does that make sense? So if you look at an asset class with high stable returns, we can ask, is it too good to be true? But the computer can't. So because we're so hypersensitive, because optimization is so hypersensitive to our input assumptions, because it can't use its judgment to look deeper than the data, first of all, we need to be very careful when we form the asset assumptions. Second of all, we need our overlay of common sense, intuition. We need what we call qualitative analysis. What we're going to look at today is a number of different methods of asset allocation. Some are based on mainly numbers, some are a mix of quantitative and qualitative analysis, and some have pretty much no quantitative modelling whatsoever. Right? If you do the fill the buckets approach or the fundamental risk approach to the letter, so exactly as it's meant to be used, you don't rely on the numbers for the very reason that, for example, the fundamental risk approach says that the numbers are flawed. So there are some methods where you don't actually look a lot at the data. You look at your own understanding and reasoning. Or at least you look at the data, but you do the analysis yourself. You are the machine in some of these methods. After this week, we're going to wrap up our view of the different asset allocation methods. But remember, we always say that you need the qualitative oversight over the top. You need the understanding of the asset classes. So once we know our different asset allocation methods, the focus of the next few weeks is deepening our understanding of the asset classes themselves, because then we will be better at adjusting issues with Solver, or we'll be better at applying something like the fundamental risk approach, because we'll have an understanding of how, for example, the different asset classes are affected by inflation. Right, so after today, we look at deepening our view on each of the asset classes, including whether we invest local, global, or in reality, both, and how we go about implementing that, whether or not to hedge our currency risk. Then the last couple of weeks, we look at additional issues like how to implement the investment, the importance of taxes, governance, and ethics as well. So with that in mind, the bulk of today is going to be looking at additional asset allocation methods. We're going to look at 3 in more depth, and 3 I'm going to provide a brief overview of and say if you want to look at it further, you can look at it in the assignment. Now, of the 3 we're going to look at in more depth, that's liability-driven investing, benchmark relative, and the fundamental risk approach. Remember, they're not always suitable for every type of investor. Think about the word liability-driven investing. Would a defined contribution fund be suited to liability-driven investing? Defined contribution. Okay, so the thing you've got to remember about finance is that we have no left side of our brain. If you like, we're really unoriginal. So often the name tells you everything you need to know. Liability-driven investing, not asset-driven, liability, right? So defined benefit funds, would they be liability-driven investors? Yes, right? Because their liability is what? The future payments to the people that retire. But defined contribution funds are not liability-driven investors. Because remember, in a defined contribution fund, who bears the risk of investment performance? The end investor. It's not the fund, it's not the sponsor of the fund, it's the end investor. So if you're running a defined contribution fund, yes, you have the obligation to pay the retirement amount to the end investor, but the amount isn't fixed. It's the investor, it's the end investor, the retiree, that has the risk of the investment performance. Whatever is in the fund when they retire determines what they have to retire on. But a defined benefit fund has to pay a promised amount. So they're driven by the need to meet that liability. Can anyone tell me another example of a liability-driven investor? Insurance companies. What is the liability there? The claims that they make, right? If you make a claim, if someone makes a claim, the insurance company has to pay that claim. So again, they need to be very careful that they have enough assets to be able to satisfy their fixed contractual, or they're not fixed, but they are contractual obligations. Part of the issue is that they're not fixed ahead of time and that you might not know how big the claim is going to be, which means that you do have this issue of managing surplus risk and trying to make sure you always have enough of your assets to meet your liabilities in an uncertain world. So we're going to look at those two. So we're going to look at liability-driven investing. We're going to look at benchmark relative, which is actually very easy for you guys to learn because I've already introduced the concept to you. Essentially, it's taking advantage of having a benchmark to make your asset allocation more reasonable through optimization. There are other ways to go about a benchmark relative approach, but what we look at is as simple as tying down your tracking error into solver. And we're also going to look at the fundamental risk approach, which we introduced in week 2, and we'll come back to today. Once we go through those, and briefly 3 others, we're going to talk about the breakdown between alpha and beta as well. Remember, beta is an amount either in compensation for risk or what you could easily do on your own. Alpha is additional return that can't be achieved by anybody. The trouble with alpha and beta is that beta means different things to different people, which means alpha does as well. So we'll talk about how difficult it can be to pin down the right definition. So here's the asset allocation methods that we're going to go through today and that we went through in week 3 and 4. So mean variance analysis we've already done. Liability-driven investing and the fundamental risk approach we're looking at properly today, but you've already had your examinable readings on it back in week 2. Remember, I said in week 2 that I wanted to give you some of the readings early when hopefully back then your workload was relatively light. I'm guessing nobody's workload is light by now. You've all got mid-semesters, probably some assignments already. So hopefully now you can breathe a bit of a sigh of relief because your examinable readings should already be done. But just remember what you look at today in the lecture and tomorrow in the workshop, tie it back to those 2 examinable readings to create a more complete picture of the topics. Now, the fundamental risk approach, if you decide to do it in your assignment, you've already done the examinable reading, but there's a supplementary reading this week that goes through it in more detail. It's not examinable, it's supplementary, but if you want to do it in the assignment, I recommend that you do that reading as well as the reading in week 2. These last three, fill the buckets, two-stage and dynamic strategies, they're all based on supplementary readings. So for the purpose of the exam, you only need to understand as much as we discuss in class about these last three approaches. If you choose to apply any of them in the assignment, obviously then you'd want to go into the supplementary readings in greater depth. Okay, so let's start with liability-driven investing. We've said that liability-driven investing is for, well, investors that have liabilities that drive their objectives. In other words, that have to meet those liabilities. In a way, the most common approach to liability-driven investing is very similar to what we've looked at already when we look at things like mean variance optimization and sketching out a frontier. In that, when we looked at mean variance optimization, we looked at how to trace out a portfolio frontier by, at each point, asking solver to say, for this amount of return, find me the weights that will minimize my risk. And then for a bit more return, find me the weights that minimize my risk. We could do liability-driven investing in the exact same way, except rather than focusing on return and variance, we focus on surplus and surplus risk. So in other words, we're not just looking at assets, we're looking at the difference between assets and liabilities. So I'll sketch through the method that we'll use to actually apply LDI. And by the way, for your assignment, I will give you asset-driven investors, but it's still important because it's obviously examinable. And it is a method that might relate to you in the future if you end up in something like an insurance company, or if you are one of the defined benefit companies that are funds that are still out there. But the reason that we focus more on the asset-driven investing is that that is the predominant type in the industry. There's a big shift away from defined benefit towards defined contribution around the world. And Australia's always been big in defined contribution. Okay, so liability-driven investing, think about liabilities as negative assets and analyze the difference. But what you've got to remember is that there's only one area of the accounting equation, right, assets less liability, that is a choice to the liability-driven investor, and that is the asset side. Liability-driven investors cannot choose the amount, the size, the timing of their liabilities. So liability-driven investing revolves around what we call a surplus. Now, we define a surplus as your assets less your liabilities. Now, your assets is what you choose, right, because you're creating an asset allocation. So what you're saying is, how much do I want in equity? How much do I want in fixed income? How much do I want in alternatives? How much do I want in cash? So if you ignore the liability side, that's exactly the same as the problem that we've been looking at in the weeks leading up to now. Where the difference comes in is you're not just looking at your assets in terms of how much do I want, how much risk am I willing to bear, and not what outflows will I have per se. You're now saying I have actual contractual obligations I need to meet. If I don't meet them, I'm at risk of bankruptcy, right? So suddenly we have a really serious emphasis on making sure that we have enough assets to meet the liabilities, because liabilities are not a choice. If an insurance claim is made, company has to pay it. So it seems pretty obvious that there should have to be some kind of matching in terms of size and timing between the assets and the liabilities. Easy to say, but the issue that we have or have had in the past with liability-driven investors is that for a long time, up until the early 2000s, we were in strong equity markets that were performing well. And what ended up happening is that the average defined benefit fund had an asset mix of about 70% equity, 30% fixed income. Now, what's the issue? If you have to meet liabilities, what is the problem with having a 70% equity weight in your assets? It's risky, right? The average return on equities is very strong. So your expected surplus would be positive. But in reality, equities are a volatile asset class. So there'll be times when you're in surplus and times when you're in deficit. And if those times when you're in deficit coincide with major payments that you need to make, it could actually put you in a lot of trouble, and did for companies like General Motors, for example. Right? In the GFC, the auto industry, there was a lot of aging employees that were starting to retire. So when assets were down, you suddenly had a lot of obligations that you needed to make, and some companies really felt the financial strain. So, to put this in a bit more context, remember, all of this is about projections. So you're looking at expected surplus is equal to the expected value of your assets less the expected value of your liabilities in the future. Now, the way to calculate your liability value is the present value, like an asset, the present value of the liabilities that you expect, discounted at some type of interest rate. So if we put on a chart what I just said about the riskiness of equities, it's very stylized, but let's call this time, and let's call this value. Imagine that your liabilities are a constant stream. So you've got your expected value of your liabilities, which is the same as your actual liabilities, and we're going to assume they're fixed through time, just to illustrate. Now let's say that you invested in assets that were largely equities, and as a result, because you're investing in equities, they have a high expected value, higher than fixed income. So what you end up with is a positive expected surplus. So the expected surplus is greater than zero. The trouble is, in reality, through time, equity markets go through cycles. They're volatile. They fluctuate. So there'll be times when you're in surplus, but there'll be other times when you're in deficit. It's obviously not going to be as smooth as this. It's going to be much noisier. But you can see that even though you have an expected surplus, you're not always actually going to be in the surplus. Now, remember, liability value is an expectation, right? It's the present value of the future liabilities that you expect. So it may be, and we're going to go through the drivers of liabilities in a moment, but it may be that you end up in deficit, but you don't actually have a lot of obligations to meet right away. Right? Why would that be? Why would I say you might be in a deficit but not have to pay out a lot of cash immediately? Sorry? Less claims now, right? Now, but there might be big claims in the future. So the thing you need to remember is being in deficit at any point in time isn't necessarily red flags, the fund's going to collapse, because it's the future stream of liabilities. Deficit is bad, but it's not necessarily fatal. When the real problem is when the expected value of your liabilities is high, and it's not the future stream of liabilities that's high, it's your current stream. If you suddenly have a lot of claims, or if you currently need to make a lot of payouts to your retirees, If you don't have enough assets to meet those payouts, that's when you get in trouble. Now, if you don't have enough in your asset pool to meet your liability claims as they fall due, you need to come up with the difference. So in a defined benefits fund, the sponsor needs to put additional money in. Think about the GFC. The assets are dropping, particularly if it's largely equities. Companies are suffering, profits are down, cash is hard, and you can't borrow. Can you see how in certain conditions you have a lot of forces that come together so that not only do you have a deficit, but you can't meet that deficit using the cash stores that you have, you can't borrow. Something like that happens, that's when you're going to end up potentially collapsing. So to see why liability-driven investing has become such an important topic and so much de-risking is going on, you have to think about what happened up until today. Up until the early 2000s, equities were strong. They were easily outperforming bonds most of the time. So defined benefit funds were having really good surpluses. It didn't matter that they had 70% on average in equities, because equities were doing well. Then what happened in the early 2000s? The dot-com bubble burst. So that was the first warning sign for liability-driven investing. We had the crash in the equity markets in the early 2000s. There were deficits. It started to wake people up to the fact that you can't just focus on asset growth and ignore liabilities. People were starting to shift away from defined benefit funds. They were starting to de-risk within defined benefit funds. But remember, the industry moves slowly. And poor defined benefit funds only had about 6 years to shift before the GFC. By the time the GFC hit, there was still a large equity weight, arguably too large, which is why there was a lot of trouble for defined benefit funds there as well. The shift is still occurring. Defined benefit funds are still slowly de-risking. So arguably, should there be another crash, we're sitting on, a record in the bull market. What we'd like to think is that defined benefit funds would not be in as much trouble now, at least on average, but time will tell. So if we go back to the slides, the trade-off that comes with liability-driven investing is between surplus risk and expected return. Think about, let's say that you guys are running a defined benefit fund. Let's start with, I've said all costs, let's start just by focusing on expected return. You want to maximize your surplus. You've put in $1 billion and you're looking at how to invest that $1 billion to come up with as high a surplus as possible. What you guys have told me and what I've said as well is that obviously if you want to get that high return, there's an incentive to invest in equities, right? If you want to maximize the expected value of your surplus, you're leaning towards a high equity weight because the return on equities is higher than the return on fixed income. What comes with that, though, is surplus risk. Remember, and surplus risk is the volatility through time of the size of your surplus. If you have high surplus risk, sometimes you'll be in surplus, other times you'll be in deficit. And you don't want those times to come when you don't have the cash to meet a large outflow of liabilities. So that's a trade-off. You go more to equities, you have a higher expected surplus on average, but a higher surplus risk. You stick within fixed income, you have a lower expected surplus because it's a safer asset, but you also have lower surplus risk. And theoretically, if you could pick a fixed income instrument that essentially matches your liabilities, you could end up with no surplus, but no surplus risk either. And that's what the method I'm going to talk about with liability-driven investing does. It tries to find the lowest possible risk position, then ask how much surplus risk you're willing to take on. Okay, so the way we tend to talk about surplus is assets less liabilities. Obviously, positive, you're in surplus, negative, you're in deficit. You could also read a reference to the funding ratio. It's exactly the same principle, except it's assets divided by liabilities. So if you're in surplus, what is your funding ratio going to be greater than? 1. If you're in deficit, it will be less than 1. Will it ever be negative? unlikely, right? I don't know. It's pretty scary what might be going on in the accounting equation that you're actually going to have a negative value for either of those. So, okay, so funding ratio will start at 0. You're in deficit if it's less than 1. You're in surplus if it's positive 1. It doesn't matter whether you want to analyze your funding ratio or your deficit surplus. Equate both of these formulas will end up producing a similar result. Okay, so how do you want to go about implementing liability-driven investing? This approach, and I'm going to go into more detail in the next slide, hopefully you'll see it's really similar to the argument we follow when we look at normal asset-driven mean variance optimization. Remember, with modern portfolio theory, we started by identifying our minimum variance portfolio, and then we sketched up the portfolio frontier by saying at each point, if you want to either slightly increase your return, what will minimize your risk, or if you want to slightly increase your risk, what will maximize your return. That's what we're doing here, but instead of just looking at assets, we're looking at the difference between your assets and liabilities. You want to start by figuring out your minimum risk position, your best liability hedge. So this is the portfolio of assets that will get as close as possible to your liabilities in terms of size and timing through time. Right, when your liabilities go up, this portfolio, your assets will go up too. But that doesn't necessarily mean that that is the position you should hold, right? Because yes, there's a big advantage to not having surplus risk, but depending on the investor, you may actually be willing to take on some surplus risk to have that expected surplus. Because there's another side, there's two sides to think about surplus. One is, if you focus on maximizing your surplus, what you don't need to pay out is your profit. So if you think about an insurance company, you know how I say up here, surplus risk versus expected return or cost? An insurance company doesn't have a cost up front in terms of investing to meet the liabilities. They invest the premiums they're given by investors. So for an insurance company, they want to focus on maximizing their surplus because surplus is profit to them. For a defined benefit fund, you could think about it in the exact same way. Think about it as a set amount that you have put aside and you want it to grow to as much as possible to meet the liabilities, and the difference is your surplus. But remember, in a defined benefit fund, the sponsor has to put money aside. So you might also think in a defined benefit fund, not in terms of maximizing the surplus, but in terms of minimizing the cost of the fund to you. In other words, I know that I'm going to have liabilities with an expected value of, I don't know, $200 million. What is the smallest amount that I have to put aside so that it would grow to meet the liabilities? And what assets would enable me to do that? The answer is the same, equity. But for a liability-driven investor like a defined benefit fund, you might think of maximizing your surplus, or you might think of minimizing the cost of the plan to you. All right, so let's say that you want to take on a bit of risk to either increase your surplus or reduce your cost. What you're going to do is exactly what we've looked at for an asset-driven investor. You're going to say, all right, well, if I'm willing to take slightly more surplus risk, what might my surplus be? Or if I want to have a slightly higher surplus, what combination of assets would minimize my surplus risk? You're just tracing up a different type of frontier. So here are the steps involved in order to follow this. Before you can figure out what your minimum risk position is, you need to figure out what your liability value is and how it relates to asset values, right? Because if you can't match them together, you have no idea what your best liability hedge is. So the first thing you need to do is identify your measure of liability, and once you've got that, it will feed into your measure of surplus. Now let's say you're a defined benefit fund. What we call the liability value here is the NPV of the future payments to the retirees. In other words, the future projected benefit obligations. So if we fill out this equation for a defined benefit fund, we call it the present value of the projected benefit obligations for each period, discounted by a discount rate that is usually, not always, but usually some kind of interest rate. So we need to figure out what our discount rate is going to be, and what our projected benefit obligations are going to be as well. Once we have figured out our liability value, we can then characterize how it relates to our asset values. Now, there are a few different ways to go about this. The one that ties most closely into what we look at in this course is the first one, and that is, if you consider it in a mean variance framework, you want to look at your covariance between your liabilities and your assets. Now, it's really important to be careful here because when you're going to do this first one, you have an absolute shift in the way you treat covariance. When you're looking at finding a good asset portfolio, forget liabilities for a second. When you're trying to find a sensible asset allocation, you will look at covariance. Modern portfolio theory tells you to do it. When you look at covariance between assets, are you seeking assets with a high or low covariance? Low, because that's diversification. Now shift your thinking. You're looking at comparing your asset value and your liability value. You're trying to find an asset portfolio that best matches your liabilities. So when you use covariance in this framework, are you looking at assets that have a high or a low covariance with your liabilities? High, okay? So if you get a question like that in the exam, or if you're setting something ever up like that in Excel, you won't need to for the assignment, but you will if you end up in liability-driven investing. What you're trying to do here, when you're looking at matching, is maximizing covariance between your assets and your liabilities, not minimizing. The portfolio with the highest possible covariance between your liabilities and your assets is your minimum risk position. Then steps 3, 4, and 5, you start to sketch out the risk-return trade-off. Two other potential ways to characterize asset and liability relations. One is based on duration. We don't look at that a lot in this course. You may have looked at duration a bit in investments, but essentially what you're trying to do is say, what is the duration of my liabilities? And then you want to look for assets that have a similar duration. So if you have a long-tail insurance fund, so your payouts are likely to be far in the future, something like life insurance, you're going to be looking at assets with a longer duration. If you're looking at insurance for automobile accidents, you're going to have a short-tail insurance fund and look at shorter duration assets. Or you might look at an economic or factor-based model. So, for example, you might look at your liabilities and say that the key exposures of these liabilities are interest rates and inflation, which is very much the case in a defined benefit fund, and I'll come back to that next slide. So if you know that two key exposures are interest rates and inflation, you will look for assets that have similar exposures and therefore provide a useful hedge against your liabilities. Whatever method you use, you're going to use it to find your lowest risk position. And remember, that is minimizing your surplus risk, not just the volatility of your assets. Once you know your minimum risk position, you're going to start to sketch out the liability form of the liability-driven investing form of the frontier. So you say, all right, I know what the best hedge of my liabilities are. If I want to take on a little bit of surplus risk, if I'm willing to do that, how much surplus might I get? So let's assume that your minimum risk position has 0 surplus. You might say, all right, if I wanted a surplus of 0.5% per year, what is the best combination of assets to minimize my surplus volatility or my probability of shortfall, given that I want a surplus of 0.5% per year? And then you say, all right, well, what if I wanted a surplus of 1% a year? What combination of assets will minimize my surplus risk, my surplus volatility, or my probability of shortfall, and so on. So see how similar it is to your asset-based mean variance optimization. It's just that you're now focusing on matching the liability and asset values. And then, just like you did when you looked at mean variance optimization and you sketched out a frontier, the next step is to figure out the right portfolio for you, given your objectives and preferences. Some funds will be happy to take on surplus risk to get that expected surplus, others won't. And it will come back to things like, are you likely to have enough cash in your company as a sponsor to actually meet the obligation? It's going to depend on the company themselves and their risk appetite. So remember we said that the first step is to identify the measure of liability value. So the important to do that, the first thing you need to do is figure out what the key drivers of that liability value is. If you have a look at the equation here, essentially what's going to drive the expected value of your liabilities is the numerator and the denominator. So it's going to be drivers of your interest rate, your discount rate, and drivers of your projected benefit obligations. Now, if you want to maximize your surplus, you obviously want to minimize your liabilities, right? All else equal. If you're looking to minimize your liabilities, would you rather have a higher or a lower discount rate? Higher, right? Because the higher discount rate, if the discount rate's going up, the liability value is going down because it's on the denominator. So the first thing to consider is the higher your discount rate is, the higher your expected surplus is going to be, at least on paper. Now, you might think it makes sense that every fund will have a similar discount rate. Unfortunately, that isn't the case. The approaches vary quite a bit across the different jurisdictions. They're typically tied to bond yields, but the type of yield will often differ. For example, some funds will use your investment-grade corporate bonds, others will use your treasury bonds. Now, in most cases, would you expect your corporate bond rate to be above or below your treasury bond rate? Above. So if you're using a corporate bond to discount your liabilities, that is likely to lead to a lower expected value of your liabilities and therefore a higher expected surplus. But it can actually get more extreme, and it's not necessarily a good thing. And that is that if you are a US public sector fund, you can use a discount rate that isn't specifically a type of bond. It's actually the return on your assets. So let's think about what incentive that creates. We've got your surplus is equal to your assets less your liabilities. To increase your surplus, you can increase your assets, decrease your liabilities, or both. And whatever your assets are in a public sector fund in the US will determine the discount rate of your liabilities. So we've said that the higher your discount rate, the lower your liability value, and therefore the higher your expected surplus. Which portfolio is likely to give you a higher return on assets? A portfolio of 90% equities and 10% fixed income, or 90% fixed income and 10% equities? 90% equities, right? So if you're looking to increase your discount rate, you have an incentive to use equity as you're going to have a higher return on assets, which will cause a drop in your liabilities. And if you're using more equity rather than fixed income, that's obviously going to cause a higher expected value of your assets as well. So using more equity in your asset base for US public sector funds is a double whammy in terms of the surplus. You're going to reduce the paper value, the expected value of your liabilities, and increase your asset base. So what is going to be the massive incentive for these funds? Yeah, to have a high equity weight, to take on more risk, to take on more surplus risk. And that's actually what's been shown. US public sector funds have had higher than average weights in equities in their asset base, and it can get them into trouble. There's a lot of work now on trying to make sure that they do de-risk where needed. So that's the first thing you need to ask yourself. What is my discount rate? Because that will directly feed into my liability value. The second thing you need to ask yourself is, what is the drivers of the numerator? So again, take a defined benefit fund, because this whole slide is focusing on defined benefit. Well, first of all, what's going to affect your future obligations? Salary growth, because when you set the defined benefit, it's going to be based on a formula. One of the key parts of that formula is usually your last few years of salary. So it's obviously going to matter how much salaries are growing through time. The turnover of beneficiaries is obviously going to matter as well. When a fund is trying to figure out its total outflows in the future, if more people are entering the fund, what's that going to mean for future outflows? They're going to be higher or lower? With more people in the fund, higher, right? Because that's more people that are going to retire that you need to make those payments. As people leave the fund, that's going to have a downward pressure on your required payments in the future, because that's less payments you need to make in the future. So you really care about the turnover of your beneficiaries. Why would you care about longevity risk? What is the risk? If you have a full life pension, what is the risk in terms of how long people are living? You're going to have to just keep paying, right? So, I mean, if on average people are living to 80, which once upon a time they were, and they're retiring in their mid-60s, you're going to have about, on average, 15 years to make this defined payment that you need to make every period. You don't know in advance how long they're going to live. You're promising, if it's a full life pension, you're promising to pay them a certain amount each year. So then they hit 80 and you're still paying them. Turns out they're still living, they're living to 90. The average age is going up to 100, right? The longer people live, the longer you're going to have to make that stream. So as much as it's a great thing that we're healthier and we're living longer, it's not such a great thing for defined benefit funds, because they have to keep paying people because they're not dying, right? So you need to consider how likely it is that the average mortality, or the age of, what do you call it, the age at which you'll die, you need to consider how much that's going to rise through time. So obviously that means you're going to have to look at things like how good healthcare is, for example, and what improvements are likely. There's so much that goes into modelling defined benefit projections. There may be options offered. So, for example, this might be as simple as, can you choose between a lump sum payment, so you get everything when you retire, or a full life pension, or a combination? And obviously that's going to affect whether, I mean, if you need to pay a lump sum and only a lump sum when someone retires, that takes away the longevity risk. So you're going to need to be aware of whether people are going to have that choice. If you only have lump sums, that's one less risk you need to think about. You need to think about inflation, particularly when it's going to have different impacts on the numerator and the denominator of that equation. So let's say that we have a situation where there is no change in nominal wages, but inflation rises. Now, if there's no change in the nominal wage, so we're still earning the same dollar, but inflation's going up, that's obviously putting downward pressure on our real wages, right? Because we're still paid the same amount, but it will buy us less. Now, that's going to have a different effect on the top and bottom of the equation. I'll just write that a bit bigger. So remember, expected value of your liabilities is your future projected benefit obligations discounted back each period. Now, let's say that nominal wages are unaffected, so they're constant, because nominal wages are approximately equal to real wages plus inflation. Let's say inflation goes up, it is offset by a drop in the real wage, so nominal wage doesn't change. If that happens, because it's the nominal wage that is feeding into the projected benefit obligation, it's not going to have an impact or only a marginal impact on the numerator, right? I mean, if inflation goes up and real wages drop but not quite enough to offset it and nominal wages go up a little bit, then our projected benefit obligations will go up a bit. But you have two offsetting effects here. So you're not having a big impact on the numerator. Let's say that the denominator is bond yields. Typically, can someone tell me what tends to be the relationship between inflation and interest rates? Positive or negative? Positive, right? So if we have inflation, what would we expect to be happening to the discount rate It's going to go up. In terms of any immediate impact, is the fact that real wages are dropping going to have an immediate primary connection to interest rates? Or to bond yields? There's not really a connection, right? There can be a secondary connection that can take some time to filter through, but there's not an automatic quick connection between a drop in the real wages and bond yields. So you don't have the same offsetting effect. So if you have a case where inflation is going up, but real wages are dropping, you're going to have no effect in the numerator because they're balancing out, but a rise in the denominator, which is going to cause your liability values to fall overall. Okay, so even if you have a variable that does affect the numerator and the denominator, it could still have they're not necessarily going to offset each other because you might have other forces at work in the projected benefit obligations that aren't affecting your interest rates. Does that make sense to everyone? Any questions on that? So that's why it's so important to understand the different drivers of the two, because there are times where you're going to have drivers in the top half of the equation and not the bottom. And the other big thing that you need to consider is changes in accounting and regulation. This isn't necessarily going to happen very often, but when it does happen, it can have a huge impact on the defined benefit fund and on the company, the sponsor. The big case in Australia is AASB 119. This happened in the year 2000. Now, prior to the year 2000, let's say that you're a company that sponsors a defined benefit fund for your employees. Prior to the year 2000, the defined benefit fund and the accounting statements of the actual company were relatively uncoupled. You had to report it, but it was reflected partly in the notes. It wasn't an immediate connection. What happened in 2011 is AASB 119 changed. And the change meant that every dollar of surplus or deficit was directly fed into the accounting statements of the sponsor company itself, which meant that every dollar of deficit was being seen plain as day in the company accounts of the sponsor and was therefore affecting company profits. Now, think back to corporate finance. Remember, if you're an equity holder, you're going to get dividends from profits. And when you have a highly volatile company in terms of the profit amount, it's going to create some uncertainty in investors. So it's likely that if you suddenly have a huge increase in profit volatility, it will affect your share price. Okay, so suddenly these companies that have been having, a great time with a lot of equities in their asset base of the defined benefit fund, that was creating surplus volatility, but they were still having an expected surplus overall, had an extra issue with the surplus volatility because it was creating volatility in their financial statements. That was affecting shareholder confidence, and it affects share price, which obviously affects the amount. One, it affects the perception of the company in general, but two, it affects the amount they can raise capital in the future. So what do you think is going to happen with this accounting change? What would you expect companies to do in response? Yeah, they'd want to de-risk. Again, they'd want a more stable asset base so that they don't have a highly fluctuating surplus amount. They have less surplus risk, so it's having less impact on the financial statements of the sponsor themselves. Okay, so something like that, it's a major change, and it has had a big flow-on effect. And it's also, it's just another reason why more and more companies are saying, we don't want defined benefit, we don't want that obligation, we don't want to bear the risk of investment performance. Yes, all right, if we have a surplus, that creates profit for us. But remember, companies are set up to profit from their key business, right? Focus on that and take the risk away from the company and put it on the end investor in a defined contribution fund. So there are still defined benefit funds, but it's helping to further the shift. So that's liability-driven investing. You won't do it in the assignment. It's not a big focus of the course, but given that it is two of our investor types, it is important to be aware of the different issues surrounding applying it. Are there any questions on that? Yes. Your risk is lower. What was that last bit?
I mean, if people are withdrawing, you have less cash to manage.
I see what you mean. No, so what, by turnover of beneficiaries, it is true as people are leaving, you have less cash to manage, but you've got to always put more money aside as you have more people come in. So if you have, so there's two parts of this. One is with turnover, if you've got a lot of people leaving the fund, you have less cash to manage. But remember, you also have less people in the fund. So you've always got to think about it as the amount of assets that you're managing per the person that is going to retire. So the biggest issue in terms of having less cash to manage, for example, is if you have a lot of outflows and you need to sell off assets, you wouldn't want them to be tied up in illiquid assets where you're having a haircut, because that will reduce the cash you have to manage per person as well. But the other thing in terms of people coming in and out is if you have a high amount of turnover of your beneficiaries, if people are leaving, that's less obligations and less people that you're managing the assets to meet those obligations, but it's also creating uncertainty. So in a way, if you have a very stable number of people in your fund, you have less uncertainty to manage in terms of how many people are going to come in the future, who is going to leave and move to another job or another type of fund. So a high turnover creates another form of uncertainty, which is another form of risk. And if you are more uncertain about what your future obligations are going to be, you might want to de-risk your policies as well. Any other questions? All right, so that was quite an involved approach, which is why I put this one in the middle as a sort of very quick, oh my gosh, I've just learnt an approach in about 5 seconds, because the benchmark relative approach is really valuable, particularly in mean variance optimization, and it's also really simple to apply. There are more complex versions that I'm not going to take you through. I used to take people through something called a chow function, which is a way to use utility for a benchmark relative approach, but the focus in this course is on applying it. You don't apply utility functions, so I'm now focusing just on what you guys can actually do in Excel for this method. Benchmark relative is a wonderful way to calm an optimizer down and stop it going to error maximizing solutions. Because remember, we said a couple of weeks ago, if you include a relative constraint, in other words, relative to another realistic looking portfolio, you're essentially tethering the optimizer to look something like the portfolio that you're tethering it to. You'll ask it to improve on it, but it's still constrained to have a reasonable spread across asset classes. Essentially, what you're doing in the benchmark relative approach is you're adding an additional constraint to your mean variance optimization. So remember, let's say before what you would say is, all right, solver, I want an 8% absolute return target per annum. I want no more than 20% of my weights in illiquid asset classes, and I don't want you to short sell, and you can't leverage. So given these constraints, find me the assets that will minimize my risk. Now, if that's what you're telling Solver, you are putting constraints in. It's not going to put everything in illiquid assets, but you're not tying it to another portfolio that has a reasonable asset allocation. So you still have a fairly decent risk that it's going to go as much to a corner solution as you enable it to do within the constraints. If you say the exact same thing to Solver, all right, I want an 8% return, what did I say, 20% in illiquid asset classes, you can't short sell, you can't leverage, and I want you to have a tracking error of no more than 1.5% per annum relative to the average of my peer group, suddenly that one constraint, and you should experiment with your assignment. I'll give you, at least for one investor, I will give you a tracking error constraint. Have a look, try it without and with the tracking error constraint, and it's quite remarkable. The second you tether Solver to a realistic looking portfolio, Solver can't deviate too far from those weights because the tracking error will explode. If you have a benchmark that has a good spread of assets between equity, fixed income, cash, hedge funds, private equity, direct property, infrastructure and commodities, and you're telling the optimizer your tracking error can't be more than 1.5% per year, the optimizer can't go and put 90% of its assets in world fixed income, right? Because the tracking error will explode. Now, the key what's the really important, if you're going to do this, what's really, really important in terms of setting up that tracking error? You're tethering it to a benchmark, right? So what do we need to make sure we're doing with the benchmark? Yeah, it needs to be a sensible benchmark. If it's a peer group average, it's going to be a reasonable spread. If you want to tie it to a legacy portfolio, remember, what's a legacy portfolio? You've just come into a new fund, so your legacy portfolio is the portfolio, that existed, that you're inheriting essentially. So let's say that you inherit a portfolio with a massive home bias and a huge equity weight. If you tether the optimizer to your legacy portfolio, it won't take you very far in correcting that. Now, that might be what you want. You might not want to change too much at once. But you've got to remember that if you are going to impose a tracking error constraint, it can only go so far from the benchmark that you've set in Solver. So you need to be sure that it is reasonable for the purpose. But once you've done that, it's very effective. So essentially, to estimate the tracking error, the easiest way to do it is take the returns of your portfolio, subtract the returns of your benchmark, and take the standard deviation of the difference. Chuck that into Solver as an additional constraint, and you're done. So I'll put at least one investor, I'll put a tracking error constraint in the assignment. So in the workshop, I'll talk about it again and how you want to set it up. So that's it. That's a benchmark relative approach. Quick, simple, and useful. So far, those two approaches have been relatively quantitative. You have common sense overlying them, but they are using the numbers to a large extent. The fundamental risk approach is the reverse. It is a qualitative approach, and if you use it in its purest form, you actually don't rely on the numbers at all when it comes to generating output. It is just your intuition, common sense, qualitative reasoning, and actually thinking about the risks that lie beneath the surface. So remember the risk, we had objectives at the top, then you had the surface risk of quantitative measures, and then what lies beneath, which is the qualitative reasoning. In the fundamental risk approach, you're jumping straight to that bottom layer. So the fundamental risk approach is all about economic diversification and looking at your portfolio with economic diversification in mind and saying, at the margin, how can I do better? It's not about building a portfolio from scratch. The fundamental risk approach assumes that you're coming in with a portfolio, and then you're saying, all right, well, if this is what I'm starting with, let me use my economic reasoning to think of changes that will diversify away fundamental risks that the portfolio is exposed to. So there's two steps. The first is you need to figure out what your big fundamental risks are. Remember, we've spoken briefly about this in week 2. And in fact, this chart here will be familiar to you, but I want to go through the whole thing again. You've got to think, what are my big fundamental risks for my particular portfolio? And they will differ depending on the investor. Once you've done that, you need to consider how you might make small changes at the margin to your asset allocation. And when you're doing it, the goal is that you want to try to find switches that don't reduce your return too much, but that do reduce the exposure to that particular fundamental risk. Sometimes that's more achievable than others, depending on what the risk is. So let's give some examples. Let's say that let's go back to the example I just gave, actually. Let's say that you inherit a portfolio that has a really large home bias. Let's say that 85% of its weight is in the Australian equity market. Now, equities is another risk that I'll come to on the next slide, but if you focus on the home bias, the fundamental risk approach would be to say, okay, well, my key fundamental risk is tied in how the Australian equity market performs. You want to find in step 2 a portfolio modification that ideally will reduce the exposure to the fundamental risk but not reduce too much return. So think about the different asset classes that you're given in the Excel tuts and that we talk about in the course. What might be an asset class that will reduce the exposure to the Australian equity market but hopefully not sacrifice too much return? World equity, absolutely. World equity hedged, world equity unhedged, emerging markets. You've now got 3 different asset classes that you could potentially shift weight into. Now remember, this is at the margin. What would happen if you said, okay, well, I'm going to sell all my Australian equities and buy world equities with all that money? You just have a new set of fundamental risks, right? It's now your fundamental risk is how the world equity market performs, or how if it's the UK, how the UK performs. If it's emerging markets, how a particular emerging market performs. So it's always about marginal changes, which really suits the fact that that's what happens in the industry. You don't come and sell everything and buy everything new, because you're going to have huge transaction costs, potentially redundant transactions, and you're going to take on a lot of peer risk, because remember, portfolios are built traditionally along similar lines. But you're going to say, all right, let's ideally keep the return pretty similar, because world equity and Australian equity returns are fairly alike, but reduce the exposure to the Australian equity market, right? You're still exposed to equity risk in general, particularly nowadays when equity markets are correlated. But that is one fundamental risk that you're reducing the exposure to at the margin. Let's say that you inherit a portfolio, you're in a multi-asset class fund, and you inherit a portfolio that has a really high weight in financial assets, and in particular, you have a really high weight in real estate investment trusts, so listed property. Now, we haven't done this yet, but what we're going to look at when we look at property is in the short term, not so much the long term, but in the short term, because listed property is listed, it suffers, or it's subject to the same fluctuations as public equities are. It's subject to the whims of investors. It's easy to buy and sell. So when times are good, they'll buy. When times are bad, they'll sell. So the correlation between listed property and public equity in the short term is a lot higher than the correlation between direct property and public equity. Now, you might think that with property, with it being a real asset technically, you might think you've got a good inflation hedge. But because it's listed in the short term, you actually have less of a good inflation hedge, because it's subject to the fluctuations of the equity markets, and financial assets do a lot worse than real assets in times of high inflation. Okay, so you've got a large equity weight, a large fixed income weight, not inflation-linked bonds, right, nominal fixed income, and you've got a little bit of money in a real asset, but it's listed property. So it still has essentially, it still suffers in times of inflation. If inflation is the risk you identify, what do? You take a bit of the listed property and you put it in direct property, right? Because you're saying, all right, well, property provides me with a good hedge against inflation, but the actual type of property that I have invested in is not my good inflation hedge. Direct property, I can find a portfolio that will potentially offer similar returns, but is a better hedge of inflation, because it not only hedges inflation in the long run, but also in the short run as well. Now, these are all specific examples that, let's face it, I've chosen because there are alternatives that have a similar level of return. In reality, most switchers are unlikely to do that. Let's say that you want to invest in relatively liquid assets. You're not going to property isn't an option to you for whatever reason, and you want to find an inflation hedge, but you're really only choosing between equity and some type of fixed income, right? You've got a lot of money in equity, you're exposed to inflation, so you instead want to take some of that investment and put it in inflation-linked bonds. A completely realistic and rational response to protecting against inflation risk. But what's the problem here? In terms of the goal of step 2, return, right? I mean, fixed income has a lower return than equity. Inflation-linked bonds has a lower return than nominal bonds, typically. So most of the time, the switches you make, which are really sensible switches, will reduce your exposure to fundamental risk, but unfortunately, they will also reduce your exposure to return. Reduce the return that you get. Now, that's not the end of the world. I'm going to come back to this in a couple of slides, but keep it in mind. But what it will mean is, often we're going to make switches that will reduce our return. It's not the end of the world in a fundamental risk perspective, providing you can use leverage to get your return back up, sort of like the modern portfolio theory argument. Okay, so that's the goal. What is my key fundamental risks? How do I tweak my portfolio to reduce the exposure? And ideally, I want to keep a similar return. Now, remember I said that what your fundamental risks are going to be is going to depend on the investor that you are. Now, in this course, we focus a lot on a standard superannuation fund. If we're going to keep a typical super fund focus, then let's go through the fundamental risk approach with that investor in mind. And when we do that, the first thing we need to consider when we want to figure out what our big fundamental risk is the equity market. This is a really great way. It stopped in 2007 because this is when the paper was written. This is from your supplementary readings. But this is a really great way to see just how much equities matter to super fund volatility. What you have here is the proportion of the return variance of your typical super fund, it's an Australian growth super fund, that can be explained by variation in each of these asset class buckets. If we start with the black line, this shouldn't be too surprising. 92% of the variation in super fund returns through time can be explained by changes in equity, property and fixed income combined. Right? Makes sense. They're three of the biggest asset class buckets we can invest in. So if you just look at the black line, and by the way, the 97%, the way we get the percentage explained is we regress the super fund returns on these asset class returns, and we take the R squared. So the R squared in this case is 0.97. The black line actually hides what's going on, because if you have a look on this side, fixed income on its own, both Australia and world combined, only explain 11% of the variation in super fund returns. Australian property, listed and unlisted combined, only explains 20% of the variation in returns. So these are not big fundamental risks for the typical Australian super fund. Now have a look at the orange. Equities overall explain 93% of the variation in returns. Australian equities alone, forget world, Australian equities explain 82% of the variation in their returns. World equities is a bit less, 64%. By the way, obviously these don't add up because of the correlations between the asset classes, but world equities only explain 64%. That's in part because there is a big home bias in Australian super funds, so Australian equities are the biggest slice of the fund. Okay, so what this means is that from a fundamental risk context, essentially there should be this big, massive warning sign above the Australian equity market, because risks to the Australian equity market are going to mean risks to these portfolios. So that's the first thing. You want to say, well, what are my big exposures to my returns? And then you want to start teasing out the drivers of those exposures. So when we look next week at the drivers of equity returns, link it back in to something like the fundamental risk approach, because they're the drivers of your fundamental risks. But we'll go through a few of the main ones now. We've spoken about this in lecture 2, but the first thing we say in the fundamental risk approach is that we have three what it calls macroeconomic mega risks, and that is the risk of the economy, the risk of changes in the income share, and the risk of changes in valuation, which is driven, one of the big drivers of that is inflation. So, for example, risk number 1 is, think about it, I think in week 2, think about the economy as a pie. The bigger the pie, the bigger the economy. Right, so risk number 1 is essentially the part that you can't diversify away. It's the risk of changes in the income available from all parts of the economy combined. So when the economy is doing well, the total income in the economy is larger. When the economy is doing poorly, total income in the economy is lower. Really hard to diversify that away. We already know that from foundations of finance. But where we can start to have an impact from a fundamental risk perspective is this second risk, the income share shift. Remember, if you've got a pie that is the economy, the second risk is changes in the size of the slices. Because in this total economy, some of the income is going to go to workers as wages, some to the government through taxes, some to housing via rents, some to companies via profits, some to fixed income via interest, and so on. Now, remember, think back to risk 1. When the economy is down, 10,000 steps. When the economy is down, wages are lower, or people are getting laid off. So there's less money to spend on rents, so housing is lower. There's less money to spend on goods and services, so company profits are lower. And fixed income tends to suffer. The government tends to drop interest rates to try to stimulate the economy, but of course that means that the yield available is lower as well. Okay, so the economic risk overall is hard to diversify away. But there are things that can happen that will change the size of how that income is broken up. Can anyone remember the example I gave in week 2? Wages. Yeah, that's exactly it. Right, remember, and it did happen big time in the 70s, wages are paid before company profits are realised. So what can happen is if you have a big expansion in the wage share, but the total economy stays the same, it's going to squeeze out the profit share, right? Because essentially a company is producing revenue, paying its expenses, including wages, the revenue is staying the same, wages are going up, so expenses are going up, which leaves less available for profit, which leaves less available to distribute to shareholders. So if you're exposed to the profit share because you've invested in equities, but not to the wage share because you can't really invest in people per se, then if the wage share expands, you're going to be hurt because your slice of the pie has reduced. The fundamental risk approach says, all right, well, is there any indirect way of gaining an exposure to the wage share even though I'm a super fund? And can anyone remember what one way of doing that is? Houses, investing in housing, property, right? Because remember what we said, when wages are higher, people have more money to spend on rent, the property market does better as well. They have more money to build, construction's going well. So you can essentially find indirect ways to get exposure to certain slices by investing in other slices. So if you're a big super fund, if you're worried about the profit share, take some of the money out of your equities and put it into property. And if you choose the right property, that is one of the cases where you can do that and not sacrifice too much return as well. It also helps to get rid of some of your inflation risks. So some of these switches will help multiple risks at once. And the third risk is the risk essentially of if you take your one slice of pie, how much can you go and sell that slice of pie for in the market? So that might be driven by, for example, rising discount rates in times of higher risk aversion. And another big one is it could be driven by inflation. Remember, inflation is typically positive for real assets like commodities, direct property, but bad for financial assets like equities and fixed income. And obviously I'm not including inflation-linked bonds in that. Inflation-linked bonds do well when inflation's high. So they're the first three things you might want to think about. You might also want to think about illiquidity. Do I have too much weight in illiquid assets? And is that really going to matter for me? Because, for example, I'm a super fund with member investment choice, and I might have a large amount of redemptions, so I need to sell off assets to give investors their money back. That might be the reverse of the switch I said before. I might have all of my property weight in direct property, but I'm concerned about illiquidity risk, and I might want to bring a bit into listed property because it's easier for me to actually redeem that amount to sell off the investment. You might care about structural or systemic risk. So, for example, you might have a lot of investment in a company where there's a high political risk, and so it might be that there's a big threat of nationalisation. And you might have a large home bias, like in the example I gave before. Now, remember, we're going to talk about it when we talk about equities, there are reasons why you might want a higher weight in equities, and a big one in Australia is that we're a dividend imputation system and we can get franking credits. But even with franking credits, it does seem like historically home bias has been a little bit too hard to justify. So it is a common issue with a standard superannuation portfolio. So you've figured out your switch. The next thing to do is decide how you're going to go about it, keeping in mind that a crucial part of that second step is that you don't want your switches to sacrifice too much return. The last thing we're going to look at for this approach is the importance of using leverage to apply it effectively if you want to maintain a particular return. What we have on the left-hand side is the most basic type of switch for the fundamental risk approach. You've got a particular exposure to a certain fundamental risk. It might be the risk of the Australian market, illiquidity risk, whatever it may be, and you have expected return. You start with an investment in the orange asset that has a high exposure to that particular risk, and that orange asset is one asset in a total portfolio. Your total portfolio is point A, and you can see it is high on that risk exposure. So what you want to do is you want to find a blue asset that has a similar return, much lower risk exposure, so your portfolio shifts across to portfolio B, where you have less exposure to that particular fundamental risk. And remember, obviously that's going to be very difficult with economic risk, but it doesn't mean that it's not doable with something like illiquidity risk. That said, it is typically hard to find assets that have an equal expected return if this risk is quite common across a lot of investors. What often is going to happen is you can easily find assets with a lower exposure to a fundamental risk, but also a lower return. When that happens, providing you can use leverage, you can use that to keep your return and still get rid of your exposure to fundamental risk. In panel B, we start with portfolio A that includes the orange asset, high return, high risk exposure. We find a grey asset that we tilt some, remember not all, some of our investment into, and in doing so we bring our portfolio down to portfolio C. It is better in terms of its return per unit of risk, but it has both a lower risk and a lower return. So you've improved the risk-return trade-off, but you've sacrificed return to do it. If that's the case, what you can do is borrow money, put that money in the assets that comprise portfolio C again, and shift it up to portfolio D. It has the same return as portfolio A, but a lower exposure to that fundamental risk. That's exactly what we talked about with modern portfolio theory. Remember, in modern portfolio theory, we have, in this case, just standard deviation and expected return. We traced out the efficient frontier. We took our line tangent to the frontier to be your market portfolio. And what we said is, if an investor has a low level of risk aversion, they might want to sit up here. What they'll do is they'll put all of their own money in the market, borrow some more money to shift up the capital market line. What we're saying in the fundamental risk approach is focus on the key risk that's relevant for you, right? So not every investor has the same fundamental risk exposures, but find your fundamental risk. If to diversify away you need to end up in a portfolio with a lower return, use leverage to get your return back up. Now, in the past, that was fairly difficult for a lot of super funds because leverage wasn't always a choice for them. However, nowadays, the restrictions on leverage are starting to ease. So it is becoming a lot more feasible, which is meaning that the fundamental risk approach is being able to be used in practice a lot more by superannuation portfolios. So you might wish to use that in your assignments. It's not the most common method. People tend to use quantitative methods, but I've also seen some killer assignments that have used the fundamental risk approach as well. And if you do remember, look at the supplementary reading as well as the examinable. All right, let's take a 5-minute break. We'll come back at 25:02 and I'll go through some of the other methods. All right, guys, now these next 3 measures, I don't expect you to know these in any depth in terms of the exams. I'm giving them to you to give you an idea of the breadth of methods out there. If any of you do want to use one in the assignment, and some people, for example, might use a 2-stage approach, if you do, then each of these methods are tied to a particular reading that you'd want to go through in depth to apply, and you're welcome to ask me questions on them if you do choose to apply them. But I don't expect you to know them in depth for exams. I just want to sort of say, here are 3 other things broadly that people use. So we'll go through them fairly quickly, but keep in mind that they are options. I don't recommend this first one for the assignment, mainly because you need a lot of knowledge of each asset class and you guys are just starting out. The fill the buckets approach, I've actually mentioned it before. It's conceptual. It doesn't involve quantitative modelling. It involves pure reasoning based on your own knowledge of and understanding of the different asset classes. So you have that pool of money. We actually sketched it out in the diagram of the course. You have a pool of money and you say, all right, well, of my $1 billion, how much do I want to put in equity, how much in fixed income, how much in alternatives, and then, in this case, how much in this other bucket, which are sort of strange returns that change through time that aren't long-term investment strategies. It's why they call it opportunistic. So you decide, how do I broadly spread my dollars between these buckets? Then within the bucket, you do the same thing. All right, well, I have, of the $1 billion, I have $500 million in equities. How much do I want to put in Australian equity? How much in global? How much in emerging markets? And you're making these decisions not based on the numbers, but based on your understanding of the different asset class, their risks, their rewards, and their future growth potential. And if you're good at it, then above all of that is an alpha bucket that doesn't come specifically from your knowledge of the different asset classes. It comes from opportunities that are constantly changing through time that you might capture. So, for example, you might end up getting alpha from taking a bond strategy. You might get alpha because you have a particular Australian equity market manager that has a very concentrated small cap fund that outperforms. So the alpha isn't a given. It's only if you end up pursuing strategies within some of these buckets that will give you that additional risk-adjusted return. But the broad decision for the fill the buckets approach is how much do I feel comfortable placing in the different buckets, and within that, in the different strategies. See why I say probably not what you want to do in the assignment, though, because you need to justify why you make these decisions. And the fact is every investor will have different reasons for coming up with their allocation here, but it has to be backed by a lot of experience. And the other thing that's important is if you're going to outsource the management of the different elements within the bucket, you need to actually have knowledge in picking managers, and it becomes particularly important when it comes to your alternatives, right? The right private equity manager will make a lot of money. A bad private equity manager will lose you a lot as well. So that is outlined in the paper called A Model for Portfolios. The next one is the two-stage approach. You might have looked at this in other courses. I don't expect this to be used commonly in the assignment, but I do see it occasionally. The two-stage approach is nice because it uses optimization, but because it acknowledges the limitation of optimization, it essentially only uses optimization where it sees it as safe to do so. So the first stage of the two-stage approach is to take the asset classes that are less exposed to issues with error maximization. Right, so you wouldn't use direct property in an optimizer under this approach because of the smoothing of returns, understating volatility. In the first stage, you get your major asset class exposures where the data is quite good and optimization is relatively safe. Right, so that's your public equity, listed property, fixed income, cash. And you run those through an optimizer. That third point, you use equal expected returns for the major equity markets. The paper talks about why in detail, but essentially what it says is, look, most of the subsets of a key major equity market in the long run should have similar returns. You're not trying to look, by trying to forecast expected returns for asset classes where really, give or take, they're pretty similar, the risk is you're going to cause error maximization by overestimating one of the returns per unit of risk. Instead, use equal returns for the major equity markets and focus on the risk minimization side of it. Okay, so that first stage is, all right, forget about the alternative asset classes. Let's use a couple of assumptions and figure out an initial starting point for our broad asset class weights. The second stage is to tweak the output from your first stage by, for example, bringing in some of the asset classes that don't perform well in an optimizer and bringing them in using qualitative judgment, right? So this is where the human comes in stage two, and tweaks the computer, what the computer did, and said, all right, well, maybe I want to add in a bit of private equity. I'm not going to ask the computer how much, because there's smooth returns, because of appraisal valuations, and there's also things like selection bias, but maybe I'll bring in a bit of private equity because I do know a good private equity fund. Maybe I'll take a little bit of the listed property and put a bit in direct property. I won't tell the optimizer, I won't ask the optimizer to tell me how much because it will tell me too much, but I'll put a bit in. Maybe I will now put a little bit more weight in Australian equities than world equities because I know a good Australian small cap manager that I think will give me alpha. So the second stage, you're starting to bring in your judgment. You're using your beliefs, your logic, your experience, perhaps simulation and sensitivity analysis. But you're not doing the second stage in the machine. So this is actually a nice balance between the two. Outside of the two-stage approach, a more informal way of doing it is to just use optimization and then tweak it with qualitative considerations. And I expect everyone that does optimization to bring in qualitative considerations in the assignment. But if you wanted to do it in a formal method, you'd use the two-stage approach. Dynamic strategies you already know about because I've told you all about them in the context of life cycle funds. Remember, a dynamic strategy is able to respond to the fact that investors and investment opportunities change through time. Exposures change, risks change, new asset classes come in. And a classic example of this is target maturity funds, which I've told you guys is one of my favourite concepts because as someone that has a terrible memory for life admin, I just know that I'm going to struggle to remember to de-risk my superannuation allocation. It's high growth at the moment. It can stay high growth for quite a while, but at some point I'm going to need to start winding that down towards conservative, right? Growth, balanced, conservative. I'm worried I'm going to forget to do that. Life cycle funds does it for you. And that's particularly important for people that don't actually have the underlying knowledge of the right policy as they age, because they don't have experience in the superannuation industry. So you can see here a typical, what they call glide path. When you're in your 20s, you've got a very high stock weight and more risky stocks within that. So more international, more emerging markets, more small caps. As you age, you reduce your stock weight and you tweak your stocks to become more safe. You increase your bond weight. And you can see that most of the change in this glide path starts to happen in about your 40s and then increases quite sharply till your early 60s and then levels off. This is a really wonderful concept. I think it has a lot of potential in the future. What's interesting and what is now updated as of this year is that there's just been a draft report into super by the Productivity Commission, and life cycle products in Australia, which make up a third of the MySuper offerings, are actually doing badly. They've ended up with less return and pretty similar risk to your other standard portfolios. The reason for this, by the way, is that one of the big reasons, I should say, for it, is see how on this glide path, you're really not making big changes until your 40s. In the MySuper offerings, in the life cycle offerings within MySuper, they're tweaking as soon as your early 30s. In other words, they're de-risking too soon. There's no point being in a large bond allocation in your super if you're not going to retire for 40 years. Okay, so it's important to tweak it, but you go too soon and essentially you've lost your return and you didn't need the reduction in risk yet because it wasn't, remember, it's all about the risk that is a risk to you. Equity market fluctuations in super is not a big risk to you when you're young. It's a big risk to you when you're close to retirement, right? So by shifting too early, you've lost your return and you haven't really affected the risk because you haven't got rid of a key risk to them at the time. Does that make sense? Yeah, so I'm hoping that, I don't think the life cycle will be dropped, even though they are getting a bad rap at the moment. I still think it's a wonderful concept, but the adjustment has to be done reasonably. Okay, so there are 3 example strategies, and they're the type of asset allocation things that you could look at. What I will do for the first half of the workshop, before I then talk about the mid-semester exam, is go through the concepts of alpha and beta. Now, just to get you guys thinking about it before the workshop, let me set it up by saying that until now, you guys have probably just looked at asset pricing models for your beta. You've mainly looked at the CAPM. You started to look at Farmer French and Carhart. Your beta that you guys have learnt theoretically is what you'd consider to be compensation for risk that you can't get rid of, right? And your alpha is any return in addition to the return that is only because of beta. What I'm going to talk about is that, first of all, even within that definition, the amount that's alpha is going to depend on what beta sources you use. But more broadly in the industry, we tend to think about beta not so much about non-diversifiable risk, but about something that you could easily replicate without paying a lot of money for on your own. Okay, so what we're going to say is there are so many different ways to look at beta that we're always talking about achieving alpha, but the fact is, with every different way of defining beta, your alpha is going to change, which makes it very hard to define. Thanks, guys. We'll go through that in the workshop. We'll also go through the mid-semester exam guidance note, and I'll talk about a couple of multiple choice and short answer questions for the past exam as well.